Want to write off your car for your real estate business? Here are the top 5 things to know. As real estate investors, we all use our car for our real estate business. Whether you are someone doing fix and flips, wholesaling, or just the landlord, there are tons of ways that we use our car in our real estate activities. And guess what? The good news is when you use your car for your real estate, the IRS allows us to take a tax deduction for that, even though your cars probably are in your personal name. I'm going to talk about the top 5 things that you need to know when you're using your car for your real estate business and how you can maximize your tax savings. The first thing to understand is that you can deduct your business use of the car regardless of whether you have an LLC or not. That's right. Even if you personally own your vehicle, you can still deduct the business use portion of that car every single year. A lot of investors come to us and they think that, or they're told that they have to have an LLC formed in order to write off car expenses, and that's not true. Even if you just have one single family rental property held in your personal name, as long as you use your car for real estate activities, you can take deductions for that car expenses. The other thing to keep in mind is when we talk about business use of your car for your real estate is not just limited to you driving to the property. A lot of investors have told us, oh, I think I can't write off my car because all of my rentals are out of state. Well, guess what? There are a lot of different ways that you use your car for your real estate business beyond just driving to the property. For example, you might be driving to meet with your real estate attorney to talk about entity formation to protect your real estate. Those are tax deductible car uses. Also, you might be driving to meet with your CPA or another investor or your realtor or your lender. Those are all business deductions. What about driving to go to Home Depot to pick up some supplies for your properties? Well, those are deductions as well. So business use of a car is not just limited to driving to and from properties. It includes all sorts of other activities that you do as a real estate investor. Now, I talked about how you don't have to have an LLC in order to take car expenses. The other thing to know is that even if you do have an LLC that holds your rental properties, your car does not have to be held inside the LLC for you to take the car expenses. For example, your rentals might be held in LLCs and your car might still be in your personal name. Perfectly fine to claim business use and take advantage of some of those tax deductions for your vehicle. And in fact, sometimes it's actually bad to have title of your car held in an LLC where your rentals are. One reason could be that if you have to finance your car, maybe holding the car in the LLC could result in higher interest rates on financing. Or oftentimes what we've seen is that when title of a car is held inside of a business, sometimes you pay higher insurance costs month after month as well. If you have a car that's 100% used for your real estate, it's perfectly fine to have the LLC hold title to the car. But again, it's not a requirement for title to be held in an LLC for you to take tax deductions for your vehicle. The other thing you need to know about using your car for your real estate business is making sure you track your miles. That's right, miles. It's a thing that nobody likes to talk about because it sounds to be very tedious, but you do need to track your miles. If you are going to take standard mileage deductions, we need to know what are your business miles that you drove for this specific year. Even if you're going to take actual tax deductions, we'll talk about that in just a moment, we have to know how many miles you're driving your car for business versus how many miles you're driving for personal. And based on those two, we get a percentage to be able to calculate how much of your actual costs are business deductions. The best practice is just to have a system in place so that it automates and simplifies how you track your business miles. There are countless apps out there that you can download on your phone to be able to help track miles when you're driving. And all you have to do is toggle on and off, toggle it on when you're driving your business, toggle off when you're driving for personal. A really great way for you to track miles for your business. Now, a question I get a lot is, how do I know what my total miles are to track? A really easy way to do it is just to get an oil change at the beginning of the year and also at the end of the year. So at the beginning of the year, you know what your miles were starting, total for the car, and at the end of the year, you know how many miles you ended up with. Subtract those two numbers and you'll get your total miles for the year. All right, the other thing we need to know to maximize our tax deductions for our car expenses, we have to make sure we track all of our costs associated with it. And when I say track your cost, I mean track 100% of your car expenses. That's right, 100% of it. A common mistake that people make is they will only track car expenses when they are driving for business activities. So for example, somebody might be always paying for their gas and oil change with their personal account, but today I'm driving to the property, I'm going to use my business credit card. Don't do that. Track 100% of your car expenses. If your car is not 100% business use, you should continue to pay for those gas and oil change costs with your personal account. But you're tracking 100% of the car expenses because when it comes to tax time, we can take a percentage of that total and claim that on tax returns to get the most tax savings. The next thing you need to understand is the IRS actually gives us a couple different ways to optimize our tax deductions year after year. The two major ones is standard miles or the actual method. Standard miles is just like it sounds, right? You are tracking the miles that you're driving for your business. It allows you to deduct a certain dollar amount for the miles that you're driving. Every year, the IRS has a standard mileage rate that they provide you with, and sometimes they even change it during the year. But nonetheless, that's the easiest way to do it. But you are not stuck with just doing standard mileage. And this is the reason we recommend for all of our clients to also track their actual car expenses, because the IRS allows us to take the larger of standard miles or actual cost of the car. Let's say that last year you drove 50 miles for your business. So we take 50 miles times the standard mileage rate for that specific year. We end up with a certain number for our tax return. So basically we can compare those two numbers and say, okay, if I use the standard mileage versus if I use the actual cost, which one provided me with the larger tax deduction? And that could be the one that I claim on my actual tax return. This could change from year to year too. So let's say in the first year, I didn't have a lot of out-of-pocket expenses. Maybe the standard mileage will give me a better tax deduction. But fast forward to year number two, maybe in that year, I drove fewer miles from business, but I had larger out-of-pocket expenses. Maybe my car needed repairs or oil change and maintenance. And in year two, maybe it's a year where my actual costs exceed the standard mileage given by the IRS. And so the great thing about that is I can choose whichever is larger and claim it on my tax return. If you have a vehicle that is used primarily for your business, we can also take depreciation deductions as well. In addition to regular depreciation, vehicles are also eligible for bonus depreciation as well as Section 179. So if the car is over 6,000 pounds and it's on a truck or SUV frame, you may even be able to depreciate the entire purchase price of that vehicle. Now, this is true regardless of whether the car is purchased all cash or with financing. You see, a lot of people don't know this, but when we talk about depreciation for a vehicle, it's actually similar to real estate. We're actually starting off with the purchase price of the vehicle, not just your down payment. So there are often times when we see investors who purchase a vehicle close to the end of the year where they put very little or no money down. Even if they finance the entire thing, it is possible to take a very large tax benefit when you're using the car primarily for business purposes. The other thing to understand about car expenses is that depreciation is only available with the purchase of a car. Like I said, the purchase could be all cash or with financing, but it must be a purchase. In other words, if we are leasing a car from the dealership, we cannot take depreciation on the vehicle. And the reason is because in that scenario, we don't own the car, right? The car itself is owned by a dealership. When we talk about depreciation, those are going to be for purchase properties. Now, that doesn't mean you should not lease a car. There are a lot of times where leasing a car might even be more beneficial than actual purchase of a vehicle. When we lease a car and you use it for your real estate business, you can write off the business use portion of that lease every single month. So as a simple example, let's say my lease payment is $100 a month, 80% for business. Well, I can write off $80 every month on that vehicle lease expense. And even for a lease vehicle, we can still decide and optimize our tax deduction when we're looking at whether we should do the actual method or if we are better off using the standard mileage rate. You know, most investors use a vehicle for their real estate business. Not many people go out and buy a car specifically for their rental property. So it's really important important to understand that with a little bit of tracking, with a little bit of understanding, we can set ourselves up to be able to take a tax benefit on the business use of our car. This is such a really simple and easy way to save on taxes because it's really a way for us to shift some of our personal expenses into business deductions. And the reason I say that is because most of us always just have a car anyway, right? So generally, when you have your car, you're driving it around for personal things, it's not a tax deductible item. It's just a personal expense. But as a real estate investor, if we can capture the amount of time that we're using that specific vehicle for our real estate business, now we start to turn some of those personal expenses into legitimate tax write-offs. If you like this video, be sure to hit the like button and subscribe for more tax saving strategies for real estate investors. Want to get more tax savings tips? Check out the description below to get access to my free tax savings toolkit.